Hi everyone, I'm Emily Carter and welcome back to Stock Stories. Today we're diving deep into Devon Energy, ticker symbol DVN. This Oklahoma-based oil and gas producer is not just another energy stock. Behind the scenes, Devon is running several high-impact projects that could redefine its future, from massive optimization programs to cutting-edge energy infrastructure developments. So let's take a closer look at what's really happening inside Devon Energy. Devon Energy is one of America's largest independent oil and gas producers, with key operations across the Delaware Basin, Eagle Ford, Williston, and Powder River regions. In 2024, Devon produced roughly 848,000 barrels of oil equivalent per day, and about 3/4 of that came from oil and natural gas liquids. That means its cash flow is highly tied to energy prices. But what really sets Devon apart is its commitment to efficiency and shareholder returns. They're not just producing oil, they're transforming how they operate. Let's talk about the projects shaping Devon's next chapter. In 2025, Devon kicked off a bold new initiative called the Business Optimization Plan. The main goal? To generate an extra $1 billion in annual free cash flow by 2026. To make that happen, the company is streamlining its drilling and production operations, cutting overhead costs, expanding automation across its processes, and allocating capital more efficiently. By the end of 2025, Devon expects to complete about 30% of this transformation. And if it works as planned, this could be a real game changer, lifting profits even if oil prices stay flat. Now, Devon's heartbeat is in the Delaware Basin, one of the richest oil-producing regions in the United States. One of its flagship efforts there is the CBR 12-to-1 multi-zone development in Loving County, Texas, a 21-well system that taps multiple layers of rock, including the Wolfcamp and Bone Spring formations. Across 2025, Devon plans to drill roughly 265 new wells, which should keep production growing and margins healthy even in a bumpy price environment. These developments strengthen Devon's reputation as one of the most efficient and low-cost operators in the entire shale sector. This next one is fascinating. Devon is actually exploring the idea of building its own electrical grid in parts of New Mexico's Delaware Basin. And the reason is pretty simple. Power shortages in that area have been slowing down oil field operations. So Devon plans to build over 800 miles of private power lines, creating a self-sufficient energy network that guarantees a stable electricity supply for its production sites. CEO Clay Gaspar describes this as a defensive innovation. It's designed to protect operations from grid disruptions and significantly cut electricity and downtime costs. Financially, it ties directly into the optimization plan, improving uptime, lowering per barrel expenses, and making Devon's operations far more resilient. In 2025, Devon signed 2 major long-term natural gas contracts, one lasting 10 years and the other 7 years, together covering more than 100 million cubic feet per day. These agreements create reliable, predictable revenue streams and help cushion the company from sudden swings in commodity prices, a smart, stabilizing move in a highly volatile market. And finally, there's the Grayson Mill Energy acquisition, a $5 billion deal completed earlier this year. This move expands Devon's presence in the Williston Basin, adding new reserves, more drilling opportunities, and higher production capacity. Sure, it brought some short-term debt, but in the long run, it strengthens Devon's multi-basin strategy, boosts output, and could significantly increase free cash flow over time. In the second quarter of 2025, Devon reported $4.28 billion in revenue, up about 9% year over year, slightly above Wall Street expectations. Adjusted earnings per share came in at 0.84, again beating estimates. But here's what really stands out. Devon generated nearly $600 million in free cash flow and returned about 70% of that to shareholders. That's a very shareholder-friendly approach, and it's why many long-term investors love this stock. At the same time, management has been extremely cautious with capital spending, keeping CapEx lower than forecast and focusing on efficiency gains. And speaking of efficiency, Devon recently launched a business optimization plan, aiming to add $1 billion in annual pre-tax free cash flow by 2026. That's a serious boost to long-term profitability. Financially, Devon looks quite solid. Its debt-to-equity ratio sits around 58%, and rating agencies like Fitch give the company a BBB+ stable outlook. That means credit risk is manageable, and the company's cash position provides a good buffer against oil price swings. So, what actually makes Devon Energy such an attractive stock? Well, first of all, the company runs highly efficient operations. It's known as one of the lowest cost producers in the entire US shale industry, and that gives it a real advantage when energy prices start to swing. Second, Devon is incredibly shareholder-friendly. The company has built a strong track record of returning cash to investors through both dividends and stock buybacks, quarter after quarter. Third, there's the business optimization plan, which gives Devon a clear and measurable roadmap towards stronger margins and long-term profitability. And finally, the stock's valuation looks appealing. Many analysts believe Devon is currently trading well below its fair value, with potential upside toward $43 per share, or maybe even higher if energy markets strengthen. But of course, not everything is perfect. Devon's performance still depends heavily on oil and gas prices, which can be unpredictable. Environmental regulations and policy pressures also pose long-term challenges for fossil fuel producers. And in the short term, technical indicators suggest mixed momentum, meaning traders are cautious and price action could stay choppy. Finally, Devon recently completed the Grayson Mill acquisition, a move that strengthens production but also adds integration and debt risks in the near term. So, what could happen next? If oil prices rise, Devon's cash flow could surge, making the stock a strong buy opportunity for value and income investors alike. If prices stay flat or dip slightly, Devon's efficiency plan might still support steady performance. But if the energy market weakens sharply, expect short-term volatility. And that's when defensive investors might prefer to stay on the sidelines or use smaller position sizes. Overall, Devon Energy looks like a solid, disciplined energy play, a company that knows how to generate cash, reward its investors, and stay efficient even in uncertain times. With an attractive valuation, strong fundamentals, and a clear roadmap for growth, Devon could offer long-term upside potential, especially if oil prices stabilize or trend higher. As always, do your own research before investing. And remember, energy stocks can move fast in both directions. If you found this breakdown helpful, don't forget to like, subscribe, and hit that bell icon so you never miss a new stock story. Thanks for watching. I'm Emily Carter, and I'll see you in the next one.